Well, it's live at 5. We're doing the happy hour with the ETF Think Tank, and I'm Dan Weisskopf. Thrilled that everybody's going to be joining us today. We've got a great guest, and it's been a long week, but a good week. I'm quite excited with some of my conversations that I've had with some folks in the ETF Think Tank. By the way, for those who don't know, I'm the ETF professor, also co-portfolio manager of Block, which is a blockchain fund, and also lead ETF strategists for the ETF Think Tank. And we work with financial advisors in helping them build better portfolios. So with that, I'm going to hand it off to David. David, you're up, man.
Thanks so much. David Chikansky here, fellow portfolio manager amongst the Title Financial Group here, focusing on the SoFi Gig Economy BYOB ETF, as well as the Amplify Inflation Fighting iWin ETF. And I will kick it to Cynthia.
Hey everybody, Cynthia Murphy, head of research for the ETF Think Tank, and that is all. I'll pass it to Mike and he can introduce our guests today.
Awesome. So I'm Mike Venuto. I'm the co-founder and CIO of Title, the parent company behind all the fun stuff we do in the Think Tank. Excited to have Kevin here. We've done a couple of other events together since we both have funds with our partners over at Amplify. So we've done a couple webinars together in a more formal format. As you all know, we like to have a little bit more fun here at the Think Tank. So we like to have a celebration word or a toasting word. So today it's going to be dividend. So you can probably guess what it's a big part of Kevin's investment philosophy. So when you hear dividend, have a sip with us. Other than that, if you'd like to be promoted up, just put it in the Q&A. Just talk in the chat. We'll make sure to respond, get you up here, get you in the conversation. And with that, let me introduce Kevin Simpson.
Thank you so much for having me. And I know we've done, to your point, Michael, a lot of very formal, traditional presentations. And I can honestly say this is the first time in the virtual bar. So excited to be with everyone.
Awesome. So just tell us a little bit about your firm before we get into questions, your firm, your fund, the things you do.
Yeah, so we're based in Naples, Florida. My company is called Capital Wealth Planning. We started in 2005. I've been in the investment business running money just over 30 years. And we've really developed a niche, I'd say over the past 15 years, focusing on investment strategies that have an emphasis on risk management, risk-adjusted total return and cash flow. Covered call writing is a big part of the strategies that we manage at Capital Wealth Planning. And as a firm, and there's 30 of us, so it's I'm not as important as I used to be, but at Capital Wealth Planning, we manage just over $8.5 billion in our covered call strategies. And the lion's share of that is in our enhanced dividend income portfolio, which we offer both as a separately managed account through financial advisors and also as a clone and an ETF through Amplify, symbol DIVO. And I know we're not talking specifics today, but just for a frame of reference, it's kind of who we are and what we do.
Awesome. So team, who wants to go first?
Well, you also do an international dividend too, right?
We launched almost a year ago, Dan, IDVO, which is an international clone of our strategy. It's a sister fund that runs the same methodologies, which are really best of breed, blue chip companies, heavy emphasis on EBITDA, cash flow, and we do utilize a covered call component there. I was brought up in the business, and my mentor told me, he said, Kevin, you can lose enough money in the US, you don't need to invest overseas. And then, I met Cynthia and all of the great investments from countries outside of the US. And we look for ADRs, big, well-known international companies, and the options, the covered calls that we're writing are US listed. So we're not looking for anything really crazy. We really want the best of breed blue chip. And if you have to invest internationally, I think our style box really resonates with lots of financial advisors.
What's
No, go ahead. Go ahead, David. I'll raise my hand next time.
What is important to look for when choosing a dividend stock beyond just the dividend? Like, what are the main things? You mentioned free cash flow. Like, do you look at the buybacks? Like, what are the main components that you assess? Is it like shareholder yield, et cetera? Overall, just top line dividend? What are your main screens you're looking for that universe.
Yeah, before I get into that, David, I was thinking, if this was the height of the pandemic and we really were drinking every time we said the word dividend, like this would last 8 minutes and we'd all be passed out.
Those
Mark
happened. We
used
just
to go
never
try
put
to
that on
get us.
YouTube.
Yeah,
Those just never made it to YouTube.
there's an
fine.
editing process.
Well said. I got to watch it live on Twitter in the future instead of waiting for the video. I think investing is easy, and that really boils down to just a few components, which is I want to own companies that have EBITDA that make money and that distribute cash flow to shareholders. And that isn't, the end all be all. I think valuations, fundamentals, forecasting forward expectations matter. But if you own companies for the long term that consistently increase their earnings, and they don't have to increase at double digit 20, 30% a year, it's just talking about old fashioned, boring blue chip companies. But if they've got good, solid single digit growth in their EBITDA and they can continue to grow their dividends, the compounding effect plays into it really, really wonderfully over time. So it's bottoms up, but there's always valuation concerns, and that's why covered call writing can help you exit a position into strength. We talk about position sizing, and we can get into that as far as a part of our four-pronged sell discipline. So I look for stocks that have good valuations, but most importantly, I'm looking for companies that make money and pay dividends.
So how big is the universe in the US that you're looking at? Is it 1,000 companies you're looking at, 500 companies?
So our primary universe is the S&P 100. We do keep a bench of S&P 500 names, and I can think of twice that we've tapped into that over the past, I'd say 5 or 6 years. But for the most part, we're looking at S&P 100 names, mega cap, bluest of the blue chip companies, and those that pay dividends. So really, and just to kind of elaborate on the dividend concept, we're looking for dividend growth as well. That allows us to have a pretty small universe relative to some of our peers. I'd say that at any given time, there's as few as 75 and maybe as many as 100 stocks that we're looking at. And our portfolio will consist of 25 to 30 names. So we really have we know our names really well, and we know our bench really well.
All right, so I'm gonna take us back a step. We kind of jumped into the strategy pretty heavy. I want to talk about ETFs for a second, though, because this is Get Think Tanked, and we're the ETF Think Tank. Your success is pretty amazing, but I think, and I've seen this over and over and over again, where people think it was like, oh, it happened really quick, right? Everybody forgets the 3.5, 4 years that Cathie Wood walked in the desert before assets came. I've lived that with plenty of funds. We have sister funds in the Amplify group. This wasn't overnight, though. So tell me how you got from, doing this as SMAs to launching it as an ETF to finding the scale that everybody is craving in this industry. I mean, I remember, years ago when we launched, we're like, all we got to do is get to $1 billion. $1 billion is useless at this point, right? You can't support having more than like 2 people at a firm at $1 billion with fees where they are nowadays, right? So just give us a little bit about the history of how you got to where you guys are today.
Yeah, I mean, it is crazy, the fee compression, when we kind of think of the landscape now versus 10, 15 years ago. When we first got into the space, I mean, the very first strategy, we still manage it to this day. It's not a portfolio we pay attention to or care about. It's just a very small representation of our assets. But we started a strategy in 2007. I think we have an audited track record that goes back to that. But even before, we were building ETF portfolios, much of what you're doing so well today. And I would literally sit down with Josh Smith, or my lead portfolio manager now, and we would look at every ETF that traded by hand. And we would score the option components within it, because you could trade covered calls on ETFs. And that's kind of how we got started in our niche. And could you imagine doing that today, like literally going through every single ETF every month by hand? So we built a portfolio that had a really good year in 2008. We wanted a hedged portfolio. We wanted a dynamic call writing concept. And it was just dumb luck that 2008 happened when it did, because what the analogy was, I was saying, if you want to buy hurricane insurance, we live in Naples, Florida, our firm's in Naples, you're not going to buy it when you see the hurricane in the Gulf. It's too expensive. And kind of conceptualizing portfolio insurance and options in the absence of volatility, we were like, okay, let's build a hedged product and buy insurance when it's cheap. So 2008 happened, and we were down the strategy, which is still available as an SMA. It was down like less than 14%, 13% and change. And that really put us on the map, because if you remember 2008, it wasn't that great a year for the stock market. So being down, 13 and change isn't as bad as it sounds. And then we started running a 40 Act fund as a clone of it. And we had some institutional accounts, but it was a strategy that's very hedged. And after a while, people forgot, how great we did in 08, and we're like, how come you're not making more money? And I said, well, it's a very buffered portfolio, but nobody cares about that. So we were really fortunate in 2012 to have an institutional, an advisor with an institutional account approach us and say, hey, we love the strategy, but we can't own ETFs. And because it was a religious institution, they needed a pure stock portfolio. They said, but we'll grandfather your track record if you can just give us the call writing the same way you do it and just give us a stock portfolio. And we were able to build this idea from scratch in 2012 and spin it out of our predecessor's strategy. And I thought, let's make it as easy for people to understand as possible, because typically with our existing strategy, the confused mind often says no. So we were like, okay, 25 to 30 stocks across all sectors, dividends, dividend growth, and we'll sprinkle in some covered call writing, and this will be great. And they're still the second largest relationship that we have today through the same financial advisor, and it's been wonderful. And that $20 million account has now grown into an $8.5 billion asset pool in this idea. Now, you and I, again, we live under the same umbrella with Amplify, and ETFs go through years of nothing happening, and really you're just praying that they don't close or go by the wayside. But as we had an existing track record for the SMA, we were able to use that in our marketing efforts. But still, it's a show me business like anything else. So just because we had an ETF that was an SMA that was successful didn't necessarily guarantee success for the ETF. But after 3 years, 5 years, and some momentum in terms of asset flows, then you can start to get attention and the acknowledgement of different rating agencies giving you some credibility. And when we really had that critical mass, which was between years 3 and 5, we were able to really parlay our success in the SMA and go to the advisors that utilize us, because typically in our world it's a $300,000 minimum to open a separately managed account. And what the ETF did is it gave exposure to advisors for smaller relationships, and for many advisors that would never look at an SMA because they're running models of ETFs on their own. So it gave us our existing relationships, as well as the possibility to meet new advisors that run a different type of business, and lots of hard work for that overnight success.
I love it. I'm gonna cut some of that and turn it into a commercial for what we do. Next time somebody's like, I'm gonna launch an ETF and tomorrow it's gonna have $1 billion in assets, I'll be like, listen to Kevin Simpson tell his story. It's grind, right? It's a lot of work, and it's not. It really does take a village of various different components and luck. Cynthia did a paper here when we were looking at likelihood of success, and most ETFs are successful in year 3, right? So it's always amazing to me that people come into this and think, I'm going to launch, and don't worry, I'll have $1 billion by the end of the year.
Unless you're Jeppy, it's not that easy.
Yeah. Well, when you bring your own assets, and you use something that's not even nobody else owns, these equity linked note things. Interesting enough.
Well, that being said, we launched iDiva, and it's been about it'll be a year next month, and it has 35 million in it, and 2 days ago it had 25 million in it.
Yep.
We fight for every penny. Yesterday was the biggest, most awesome day around the iDiva table, but it will have $1 billion, because we're going to work really hard. We're going to do a great job, but it's not going to be a year. It's going to be a long time. And that's, piggybacking off of the success of Devo. So, and you guys know, because you've done it with several funds very, very successfully, but not with the snap of a finger.
No, it's not that easy. Weisskopf, I think you had a question. I just jumped in on my follow-up.
Yeah,
first.
no, that's fine. Yeah, I mean, call it a marathon, call it a grind. There's no easy way to do it, right? It just isn't. I'm the guy who always talks about how structure matters. What I am completely lost by, and I don't know if this is going to be controversial, but what exactly is the advantage to an SMA over an ETF? Because I don't get it.
Well, we're in the ETF Think Tank, so who knows?
Yeah, but I don't know why anybody does an SMA over an ETF. Does anybody have an answer? Because I'd love to know that.
Yeah, I can give you two quick answers. So answer number one, SMA costs very little operationally. Like it's no secret that running an ETF is somewhere between 230 and 260. Running an SMA is,
Open an account.
overhead. Yeah, it's a little overhead. Number two, the institutions, the family offices, all of you out there who are listening that do any of those stuff, they still think that there's something special about them having an SMA. Right? Like it's true. Like they think they're adding value. Like I love that I'm about to cite one of our competitors, but Wes at Alpha Architect, he did this great paper where he actually did the math to show, even with the tax harvesting that you can do in an SMA, over time, the ETF's a better structure from a tax perspective, right? He did the math. So I think the SMA still exists because it's cheap, because institutions think there's some sort of glitter on it. And I guess the final actual thing is the SMA allows for some customization, right? Let's say out of the 25 stocks that Kevin's choosing, there's 2 that a client doesn't want, and the client's a high net worth, and da-da-da-da. You can exclude that in the SMA. You can't in the ETF.
So
the use cases are smaller and smaller, but that's true.
Okay, so that's a big plus for sure. As speaking as an SMA, putting my SMA manager hat on, but I think the real differentiator is the psychological value of transparency in a down market. The non-emotional attachment to a ticker of a fund. It's easier for sometimes people to make emotional investment decisions poorly than with an SMA, where they get a brokerage statement and a one piece of paper front and back. They see everything they own, they know everything they own, and perhaps it's going to allow for the conversation with the financial advisor, the SMA manager, and the reality of the investor to not do something stupid at the wrong time, which could potentially be, hey, we're in the height of a pandemic that we never saw coming. I need to batten the hatches. I need to close everything and sell everything and go to cash. If we were able to do this in an SMA format and they can see what they own, I feel like there's an emotional component to an SMA that's invaluable.
Yeah, my experience has always been there's this term that Global X has trademarked, so I'm going to say it, but we'll probably have to edit it out. They call it conversational alpha. They made us edit it out as something once before. But
I wanted conversational alpha to be our drinking word too. And
yeah.
Attorneys wouldn't let me.
Yeah. But yeah, there is some of that with the SMA, but I also think there's some conversational detractions, because if you have one dog in the portfolio, that's all the client wants to talk about.
Yeah, I never had a stock go down though, Michael. So
he's guaranteeing things.
No, because we own Verizon. Boy, do I wish people didn't see that, because I have to have exposure to all sectors, and we have a telecom, and for the longest time it was either AT&T or Verizon, and I wasn't about to own AT&T. Not that Verizon's done much better, but there's some truth in what you say about that for sure.
I'm sure you do a lot of work.
You can sell the volatility. You sell the volatility on it. That's fine.
A lot of calls.
Why don't we let David go, and then we'll go to Santiago because he's got his hand up. So
I would also say I feel like trading, especially with the added layers of complexity, can be done much more efficiently, like in an ETF, than trying to get a desk to execute. Now I'm looking at your face, assuming that you put a lot of effort into the execution of your trades and your platform, but like a true SMA provider, which I assume you don't do a lot of this because you do have the ETF, is trying to get on as many external platforms as possible. And then you have all of these third-party trading desks trading your portfolio at different times of the day. This desk likes to do it between 11 to 2, and that desk does it at like 3:30, and it's just kind of a nightmare from an execution perspective. And I think from an ETF perspective, especially if you're doing option writing, et cetera, anything a little more complex, it's just such a better way to sleep at night from your perspective to know that like your strategy is actually going to be executed correctly.
Well, we don't operate in the UMA world. We work as a manager directed. So we work directly with the desks. And I'll speak for the firms that we work with, because all the firms offer both the SMA and the ETF. So we're agnostic to how advisors access us. But the desks that we work with are excellent, seamless, so easy to work with. And we get everything done with the ETF and with the other platforms with incredible price consistency. And we're required to follow that for SEC guidelines, best execution. But in today's world, at least the firms that we work with, they're easy to work with, they're super nice, they're awesome, and they're efficient.
Yeah, you're avoiding the good harbor trap of letting somebody else take over the execution and blowing up your whole firm.
Well, you also can't change your strategy. You know, it's an old adage, you know, it's going to be different this time. Your track record is your track record. We do things once a month, but now we're going to do it every other week. That's no longer, you know, the same strategy. So they made a few mistakes.
Yeah. All right, Daniel, go ahead.
Yeah, while we're talking about SMAs, you know, there's been a lot of buzz about direct indexing over the last year or so, right? Morningstar is really big into it. So what is everyone's thoughts? Primarily, Kevin, I want to hear your thoughts on direct indexing. And does you guys have any plans to get into that game?
No, I always think that, well, let me be very respectful and tactful. You know, once I saw direct indexing get really popular,
I won't be, so don't worry.
I thought, well, the stock market's done going up. You can forget about that. We don't need this anymore. You know, we had a zero interest rate environment. It was artificial. It lasted a long time and it was awesome. And everything goes up. When you have interest rates, you can pick where you want them, 3, 4, 5%. The Fed can cut rates next year. They're not going to go back to zero. The prospects of and the need for direct indexing, I think, is less in a more normal world than it was in that artificial near zero interest rate environment. And that's not a criticism for trying to be tax efficient. It's just not a space that we're going to go after, because I don't know just at the end of the day how important it is. And there's enough great firms that do it.
Got it.
Michael, you can be less tactful or polite.
Yeah, I'll get mine, and David's got one that I tend to agree with. So my version of it is direct indexing is just a custom SMA. It's been around for 30, 40 freaking years. Our friend Kevin Carter built one of the first technology platforms to actually do it. He sold it to Natixis, and it's been sitting there at the same AUM for 25 years. It's until they get technology that makes it completely easy to do with a tiny little account, I don't see it ever really taking off other than for institutional accounts. And even there, they're better off launching an ETF. So I'm not a huge fan. I think that in the environments, as Kevin was pointing out, that we're in today, you're going to run out of losses to harvest. The only caveat, and I'll let David explain it, because I've been looking at it as potentially figuring out an ETF structure for it, is direct indexing doing long short, because that you can actually manufacture tax benefits with. You're still going to have a terrible client experience. They're still going to get like 75 confirms a month and complain to you about why did you do this and why did you do that, and then they're going to complain at tax season. Like, to me, that's that negative. That's a count. What's the opposite of alpha? I don't know. Conversational deterioration of client. Value. Yeah, it's not pretty.
I only know alpha,
yeah,
by the way.
But
yeah.
Mike and I explain
Yeah,
further.
David. Yeah,
So
get in there.
yeah, so Mike and I have been staunch disbelievers of the direct indexing world for quite some time, because basically you get this like massive tax loss harvest in the first year or two, and then the tax loss harvest, as Wes's paper probably pointed out, kind of trails off. You're getting maybe 1 or 2% tax loss harvest every single year, but like your tracking error shoots up ginormously, especially in this market that we've seen that's gone straight up. But the new thesis that expands direct indexing is like taking your one beta portfolio and adding a long short on top of it. So 150% long, 50% short, having that be like an alpha sleeve. And with so much on the short side, you almost always have something to harvest on the losses. So you actually have a much better shot of keeping a tracking error very low to the underlying benchmark, and also consistently harvesting losses, like going forward out like 10 years and not kind of just getting locked into certain positions. The most pristine institutional shop that does it out there is like 700 positions long and 300 positions short. A small little firm called AQR, but so it can be done, but that's like $1 million minimum. You need prime brokerage leverage on an SMA account. Like you just need so many things for that to work on an SMA level, that like most institutions, you're probably talking about a 5, 10, 20, $25 million minimum on an account size to be able to get that kind of relationship.
Hey, Daniel, I this is a little sidebar, but I don't know if you know this, but the Adesina fund that you work on started as a direct index.
I didn't
It
know
was
that.
with, yeah. So they had an SMA that was custom with the tax harvesting, the whole 9 yards with Ethos, or what is the name of it? Do you guys remember the one? This Kadar went there.
Like
guys remember the name?
leatherback could be a direct index. Like,
Well, that's true. But what was
He's
the
not
name of
a-
the company that Kadar went to? I think it was Ethos or something like that. Fidelity backed them there. But what happened was Adesina got to like 25 million, was sick of having 3,000 accounts, and we
Yeah.
moved them to an ETF structure. so I actually think direct indexing is not the ETF killer or the ETF competitor. It's like the incubator.
Yeah, I agree with your general sentiment though, that it's just a customized SMA. Like even some of the wholesalers for some of the direct indexing will try to, book some time on my calendar. And I'm like, you're just pitching me an SMA. Like we've had this forever. So agree.
All right. Well, let's get back to the covered calls, because I see a
just-
bunch of questions.
Just a
You
quick
wanna go,
shout
Dan?
out to Kadar. Yeah, just it's ethic.
Ethic.
Yeah, shout out to Kadar Wilson, by the way.
Yeah. Pour some out. Let's get back to covered calls though. So it's a bunch of questions in the chat. Some of these we're talking about pre the show, but the basic one that seems to be most common is, how do you decide the call to sell? So you pick a fundamental portfolio that's sector neutral to the market, and then what do you decide to sell against these 25 positions?
So we look at every position every day, and we like to keep our covered calls out of the money. So we like to have out of the money calls, and we like to keep them short, 30 days or less. Our sweet spot was always a 1 month call, 5% out of the money, and that's where we start. And we look and see what would happen if we wrote a covered call, if we just hit the bid on a 5% out of the money 30-day call. How much premium would we generate? And on an annualized basis, if the number was less than 2.5 or 3% a year, then we just don't write a call. And in the absence of volatility in a market, you see VIX, barely having a pulse, you can imagine that more times than not, that's the trigger we get. It's a red light, don't do anything. And that's fine, because generally there's an inverse relationship between volatility and market performance. Not always, that wasn't the case in 2022. But more generally speaking, broadly speaking, if the VIX is low, the markets are going to be a little bit more in an uptrend. If volatility is higher, if there's more fear in the market, then we might be in a downtrend or a more choppy market. But let's say that we get a green light, that the option premium is 4 or 5% annualized. It's not just AI deciding to go ahead and press a button. We look at 3 factors. We say, okay, well, do they have earnings coming out over the next month? Do they go ex dividend over the next month? And third, and most importantly, where are they trading relative to their 50, 100, and 200-day moving averages? Because the stupidest thing I could do is write a covered call 5% out of the money on a stock that's down 15% for whatever reason. Maybe the whole market's down. Maybe we had a COVID crash. Maybe oil's out of favor. I don't want to be writing calls 5% out of the money, because even a dead cat bounce could mess me up. So for 25 cents, 50 cents, $1, I'm out of a position, potentially missed a dividend, and certainly I'm not participating in that stock bounce back. So we look very carefully at where the stock's trading and how it's trading relative to those historical patterns. And that allows us to then determine where the strike price should be. So let's say the stock is down 15%. Instead of writing a call 5% out of the money, maybe we write it 12% out of the money, much closer to those bands. The premiums are still going to be really high because I would imagine there's going to be high vol in a stock that has that kind of movement. So I like to say that covered calls really do work best when we need them to most, which is in periods of high volatility. Some sectors have inherently more volatility than others, but we're looking for that kind of simple process to determine whether or not to write a covered call. We call that tactical covered call writing. I'm often criticized for being frugally covered call writing.
I'm gonna jump in here. So right now you're about 13% in retail. Banks are about 10 and pharmaceuticals are about 9. I get that your approach is more bottoms up, but do different sectors have different volatility and therefore different covered call opportunities?
Yeah, 100%, Dan. You're going to find that companies that have more volatility are going to be better covered call candidates, and companies with less volatility, generally speaking, are going to be lesser candidates for premium. If you look at the technology space, and why wouldn't we? How we've gone this long without saying NVIDIA is the first conversation that I've had that's lasted 32 minutes without saying NVIDIA, so I feel like we've gotten that out of the way. But tech names have high volatility, so we can write a lot of covered calls. Unfortunately, we can't own NVIDIA because there's no dividend to speak of. Now, I was on CNBC like a week or maybe it was last month, and they sort of tried to call me out on it, like, well, NVIDIA pays a dividend, why don't you own it? And I said, well, put the dividend up on the screen and we'll let the audience decide if that's a dividend or a rounding error. So companies that have high volatility, two names that, tech stocks, we have some tech names. We're going to be able to write good covered calls there, get good premiums. Sectors that we might not have as much fun writing calls on because there's no premium are going to fall maybe in the telecom space or the utility space. And you're typically going to be lucky if you can write a call on a utility, and you're almost always going to be able to write a call on a tech stock. For compliance reasons, I wanted to keep that really 10,000 feet above the portfolio.
Yeah, I was going to ask a silly question about the options. Like, not that long ago, there weren't really ETFs that used these options overlays, and all of a sudden they're everywhere. So it's almost like the ETF market has, choose our favorite word, democratized access to the options market to a level that now it's so common. Is there any underappreciated risk or any detriment to this, options for everybody now in all sorts of ETF wrappers? Does that change at all the ability to implement these strategies, or it doesn't affect it at all?
It's a really good question. I think imitation is the greatest form of flattery, and Devo was the first actively managed covered call ETF. I mean, we've run 40 Act funds with actively managed and used ETFs and used options in a 40 Act fund, but Devo was the first. And I think that the more attention the space gets, it's better for all of us. It's not oversaturated. It's not like an S&P fund. There's plenty of room. And as with anything, the cream rises to the top. So I'm excited, encouraged, and thrilled that there are more exposure to covered calls. When I watch television and I see any one of the commercials mentioning covered calls, it makes me feel good. I know there's people that kind of will think of me when that happens, and regardless of whose commercial it is, I think that's great. And it does lend itself to more liquidity within the options market. It's good for the SIBO. It's good for pricing. It's good for trading. It's good for liquidity. So I don't look at it as a negative, and I don't look at them as competitors. I'm wishing for their success.
So swinging back to the international portfolio, which I think probably most people are less familiar with, both because of its size as well as the companies that are in there. And we have Cynthia calling in from Brazil, for those who don't know. So we're totally global today. And thanks, Cynthia, for doing that, right?
She's down there researching Telebras for the iDevo portfolio.
Exactly. So you just nailed my question, actually. So Brazil is just under 5% of your weighting, right? The UK is about 15-16%. What kind of country mix can we look for from in that ETF as an example?
Well, that's a great question. And being someone who's got great expertise in the US and great expertise in options and very little experience internationally, I don't really run the international portfolio and the stock selection process, but the country selection process really just takes an MSCI screen and filters it through the index to inspire the countries that are represented and the percentages within those countries. And then the companies that are selected, again, you're looking for best of breed blue chips throughout these countries. But I would encourage you to have Tim Seymour come on the program. He also works with Michael and I under the Amplify umbrella. 1 hour will not be enough to hear Tim talk about the stocks in IDEVO, but he will give you an incredible, detailed, thorough analysis of every stock, every country, and probably a really great anecdote of the time his band played in a city in that country. So when we're done today, we'll try to book Tim to come and talk about the IDEVO product.
Tim has been a guest, and he's kind of a neighbor of mine in Quag. So, hey, Tim, if you're out there, I hope you're listening. We'll have you back soon.
Just have him back for IDEVO. You don't need to talk about
of course, absolutely.
Could we ask, I was just reading this morning, just like kind of a macro point, how dividend stocks kind of were a little bit out of favor, or maybe not the center of attention. I was just reading an article yesterday talking about how the latest Fed action has put them back on the spotlight. There was, I think BofA released a survey that's almost 50% of money asset managers are saying, dividend stocks are going to outperform again. This is the time to look back at them. So, just do you have any, thoughts on the big picture and the landscape for dividend stocks going forward?
It's a great question because people have such a recency bias. We live in a world now that we want everything immediately, and when we're disappointed when we don't get it. I think that, going back to what I first said, investing is easy. You buy companies that make money and pay dividends. It's going to work over time. It may be a little out of vogue right now. I would argue that people might always pay up for growth, but the dividend story isn't, going away. This was a weird year for a lot of different reasons, but Ned Davis did a great study, and they look at the performance for the first half of the year of the S&P 500 by breaking it into dividend payers and non-dividend payers. There were 400 companies that paid dividends in the S&P 500. And there were 100 companies that didn't. Of the 100 companies that didn't, through the first half of the year, they posted a performance of 18%, which is pretty good. The other 400, they were barely up 4% the first half of the year. There hadn't been a dispersion like that, a disparity between dividend payers and non-dividend payers since 2009. That was the last time it had exceeded that number. And for those of us who remember the first half of 2009, especially January and February, pretty lousy start to the year. But I was kind of thinking, like, did they declare dividends dead in 2009? I know they did in 1999 because it was, the death of value investing. Warren Buffett was over the hill. Nobody wanted to hear about anything that we were doing. I had a client that said to me that she wouldn't refer me to her worst enemy because I bought her Merck, M-R-K. I still own Merck. It's 2023. This was in 1999. I won't say her name, but she was in Princeton, New Jersey. So in 2009, I thought, what if I picked just 3 stocks randomly from our portfolio and we bought them July 1st of 2009, the last time that the dividends were completely out of favor, because there's usually a revision to the mean. On an annualized basis, Home Depot has been up 23% per year. Starbucks has been up 23% per year. And UPS has been up 13% per year on an annualized basis since July 1st of 2009. So will dividends outperform growth the rest of this year? Who knows? I look at a much, much longer, broader picture. But what I do know is that if I invest in companies whose earnings continue to increase, their share prices will follow. And it's almost like the tortoise versus the hare. Last year, it wasn't the greatest year in the world for like the NASDAQ. This year it is. So things kind of come and go, but we all tend to end up at the same place. It's my objective in managing money to end up at that place with a much smoother ride.
So I've got a question. I think I'm interpreting it right. And Warren Kaplan, this is for you because you were burning my brain earlier yesterday. Your question is what happens, Kevin, when you own a stock, right? And it goes south. How does that, for whatever reason, actually they report numbers as an example, and you're disappointed by the numbers, hypothetically, because it's an actively managed strategy, right? Are you looking at it at that moment? And if you have the covered call set up, you can unwind it, or do you wait? Or do you how do you make the decision maybe just to do the covered call because it's an opportunity for you?
First of all, Warren, thank you for your service. Thank you for the question. I've never had a stock go down. I wouldn't be able to answer that. No, I'm kidding. So we have a stock all the time. We own Verizon. So if we have a covered call and the stock goes down on earnings, it may present an opportunity for us to proactively close out that option position. It's never fun to watch your stock go down. And I remember once we bought 3M and we owned it for like 2 days, not even 3. But they came out with earnings that were so bad that we had to sell the stock for relative underperformance. But if we own a stock and for whatever reason it's down, call it disappointing numbers, just a market that took some bad news from the Fed, for whatever reason, if we write a covered call and we've captured 75% of the premium, and there's still about half or some life left in the option, we'll typically proactively close it out and consider it a win. So if we write a call, if we sell a call for $1, and we're in the position that we can now buy it back for $0.25, because yes, the stock's down $5, big deal to 75 cents. I get that, but we'll be proactive and close that position out. And it gives us the opportunity, if we want, to write another call on that same position, maybe at a lower strike price. Maybe it comes back a little bit and we're able to kind of compromise the strike, but we're not going to just let it set it and forget it. We want to be active in the option writing.
Yeah, actually, the act of like closing out your call option and not restriking is getting more aggressive in that position, right? You're increasing your beta and your exposure to that position. So it's a way of like almost like buying low a little bit. Do you write options on 100% of the contract of the shares of the underlying, or do you do it for a portion of each individual stock? And how do you think about that?
That's a good question. I always think about it. Generally speaking, if we write a covered call, we write it on the position, 100% of the position. There have been instances in which we have not, where we've done it on half the position. And it used to be a lot easier in the old days. 30 years ago, the stock would get to $100 and it would split, like pretty much religiously. So we could write covered calls on half a position because we would have more than 100 shares. Now stocks don't split. It makes it a little bit more difficult for us to be writing covered calls on a portion of the underlying position. Now, if we ever get back to the good old days, I think I'd be more inclined to use partial positions. But for now, David, if we're writing a covered call, almost always it's going to be on the full position.
Okay, I gotta ask this question because Eric Connolly always like throws the crazy question at us. Why are Japanese and Korean stock dividends so variable?
I don't know. It's crazy. They don't have to pay anything, and they don't have any rhyme or reason. In our U.S. stock, Eric, if a company cuts its dividend or it suspends a dividend, I sell it immediately, like that second, no questions asked. You look at some of these companies within the Asian countries, and it's not just there. You can look at within IDEVO at many different countries, many companies. A variable dividend is the norm, not the outlier. Now, we used to own Devon Energy in the US, and they had a variable component, but they still had a static dividend, and then they had a variable that was based on free cash flow. I have no idea what the rhyme or reason is with respect to that, and I never BS an answer. So it's a great question, and I scratch my head exactly the way you do.
So there is absolutely no circumstance where a company that cuts a dividend, even if it's a one-time situation where you would hold that stock, it's always a bad thing?
Well, let me say this, Cynthia. I don't know if it's always a bad thing, but it's more times than not a bad thing, and I will always sell it. I don't want to be the person that's going to be so smart that I'm right this time. And here's an example, because it wasn't often that you shut down the planet because of a pandemic, but we did that, which is how this podcast started. We're still enjoying it and participating virtually from all over the world. But what happened in the pandemic was Walt Disney and Company had to suspend a dividend. I mean, how could they not? No sporting events, no movie theaters, no theme parks. It was just like a no-brainer that they're going to, thank God they had Disney Plus, or who knows what would have happened. But they cut the dividend. They used to pay it twice a year. I remember the analyst call, it was a Thursday, and I knew it was not a surprise. It shouldn't have been a surprise, but it was still a disappointment, because I thought, we've owned Disney for so long. But we sold Disney that next day. It wasn't anything different. We didn't decide it's a pandemic, we're going to change our mind. And it's turned out to be a really good decision, because unfortunately, Disney hasn't been able to reinstate that dividend. They're still having problems. But I think it's important to look at that. General Electric, again, in its previous iteration, we had sold it for relative underperformance and got out at a great price. But when they cut their dividend, it was still $24 a share, which we would have sold it then if we hadn't previously. It then went to $4. I mean, I know it's done reverse splits. I know it's different now, but that's a stock that people had their entire life savings in. I think it did a reverse split to get some of that price action back, but we will sell the stock immediately and live to fight another day. I'm not so smart and don't have such an ego that I think, well, how could I be wrong?
Do you know if any of the aristocrat indexes smoothed out any dividend cuts for COVID purposes? Was there any look back adjustments on some of that? Did Disney kind of sneak under the rug there, or were they just rules based, just absolutely kicked out? And I'm gonna make a case for a variable dividend, because I think a company should pay out cash flows based on free cash flow and what they actually have available at hand. And I think it's indexes like the aristocrats indexes that have forced all these companies to just get very traditional, to show this slow and steady growth. And I don't know, maybe you are the dividend expert, so you can please.
No, you're intuitively spot on, because some of those aristocrats. Now, the first part of your question, I don't know. I would assume, maybe I shouldn't, that Disney's not an aristocrat because it doesn't pay a dividend. I don't think you get an asterisk for a COVID. Maybe you do. There are. If you guys use the interweb, we can look and see if there's a list of the aristocrats and see if Disney's on it. But I would imagine they don't get a free pass, number one. Number two, companies should pay a static dividend if you want, and then a variable dividend based on profits. Typically, they don't. Devon Energy does. Some of the energy space does. Eric pointed out a lot of these international companies do. It makes sense. So how can I look at that? If it's an aristocrat, I mean, you can look at Exxon and AT&T as examples of companies that are aristocrats that raise their dividends when they probably shouldn't have, because they probably were leveraging it at points in their corporate lives to be able to maintain that dividend increase. However, what I'm hoping to find, what I'm digging for, are companies that are increasing their dividends because their earnings are increasing to support it. Anybody can go into a mall and buy anything because you have a credit card. It doesn't mean we can afford to buy anything. It means we can buy anything. We can go in the mall and buy a Tesla, but it doesn't mean we can afford it. So a company should pay dividends based on what they can afford, and that's what we hope we're uncovering. And I think that's a good recipe for success, because if they're increasing their dividends because they're increasing their earnings, you've got a lot of pistons humming in the right direction. And aristocrats and dividend kings in a lot of cases are candidates for us to look for. But I'm really focusing on a 5-year bias in the broader trend of the dividend growth. But they don't have to pay dividends for 100 years or 5 years to at least be a candidate for us to look at. I care about what they're doing today, not what they did 100 years ago.
Yeah, 20 years is way too big of a look back. And it looks like dividends planning on issuing a dividend at the end of the year, starting the end of the year, if I'm not mistaken. So maybe
we go to
next year.
Should we go to Ray? Ray Scheimer, you got a question, my friend. Unmute.
Yeah, I do. Thank you, Dan. Question is, and again, I have these questions with a lot of ETFs, and again, it's a good problem to have that use call strategies. Any thoughts as far as sizing in terms of the ETF's been very successful. So if it continues to grow, is there a size that you see where a mutual fund might close? Obviously, ETF can't do that, where you might have an issue that the calls you're writing would start to push the market around, and if so, increase the number of stocks you own, or do you have a strategy to kind of deal with that? And what size do you think could be an issue there, if any? Thanks.
No, Ray, I mean, it's a great point. It's something I think about all the time. And if you had asked me this question, so we have $8.5 billion in our firm, including the ETF. If you had asked me this 15 years ago, and you said, well, would you be able to run your strategy on $8.5 billion, or would you have to close it if that was possible, theoretically? I would have said, no way could we run $8.5 billion. There's no chance. Like that's crazy. We'd be trading against ourselves. But we, every year, taking a little bit more AUM and continuing to raise that theoretical threshold and that theoretical bar. It has to exist somewhere, but we're not even a blip on a radar. Like we're not trading against ourselves. We have no trading issues at the size we are now. Now, if we were double our size, I think we'd have to close if that was the case, or reassess, or, when you talk about adding more positions, that seems like the natural solution. But I'm always, opposed to doing something different than we've done before. So I don't know the answer, but we have a lot of capacity for now. So drop your tickets, get your clients into the strategies that we're talking about, and support the covered call ETFs out there. But you bring up a good point, and it's something we think about. It absolutely exists, and at the moment we're not close, and it's an amazing thing for me to ever think about. Like if we were at 10 billion tomorrow, would it be an issue? Absolutely not. And I can't believe I'm saying 10 billion, and I can't believe I'm saying it would be something that wouldn't even have an issue on the options. Personally, like, can you imagine $10 billion under management? Like that's so, who doesn't dream of that? And we could handle it without any problem at today's level of option volume, which is wonderful.
Or pass it off to Cynthia. I just want to say, actually, your fund is the perfect example of like a variable dividend strategy, right? Like you are increasing your dividend when it warrants it, and decreasing it and living off of the dividends of the stock when the extra opportunity isn't there. So
it's a symptom of the covered calls. We're not paying out a dividend just to pay out a dividend. We distribute cash flow when we generate it. And that's why in the old days, so many covered call closed-end funds blew up, because they were structured products that promised 9, 10, 11% cash flow. They paid the brokers like 7, 10% commissions, and it was not a recipe for success. ETFs are really, really efficient, really, really transparent, and we have that flexibility in terms of the distribution, which is what you need for a real product.
So I think we're wrapping up. We love ETFs too, Kevin, so we have that in common. We think they're awesome.
When Dan said this was an hour, I almost lost my mind. I'm like, I have an attention span of like 5 minutes, so I don't know what you're going to do with me for an hour, but this flew by. No. Thank you so much. I couldn't have had more fun. This
was amazing. Thank you so much. Thanks everybody for joining us. I have more partying to do before I hop that plane, so I'm going to get going too. We will see you all next week. I don't know who our guest is next week. Do we know?
Sure, we do know. Jamie Coultz, who's the Bloomberg, sorry, Warren, the crypto analyst from Bloomberg. And he's developed, you'll appreciate this. He's developed a fundamental analysis of how to look at crypto. So we're going to be talking about maybe dividends.
I'll be drinking to that.
Okay. Good night, everybody. Thank you so much.
Bye-bye, everybody. Thank you.
Ciao.
Bye.